benefits from careful attention to those elements of investing that are within our power to control: risk, cost, and time. The financial media provide a good place to begin our review of the eternal search for market-beating returns, whether through market timing or other means. The media reflect the actions of the financial markets, which are determined by the investment decisions made by all investors. The media also magnify the impact of market actions by highlighting and, in some respects, sensationalizing them. Consider two covers from Business Week, one of our nation's most respected business periodicals. On August 13, 1979, Business Week ran a cover story called "The Death of Equities." The story's timing could hardly have been more unfortunate. The Dow Jones Industrial Average of stock prices was at 840 when the article was written. It rose to 960 by the end of 1980. In the next 2 years, the index declined. It scraped 800 in July 1982, but then rebounded to 1200 by May 1983. Business Week then ran another cover story called "The Rebirth of Equities" on May 9, 1983, after the near 50% market rise that had ensued since the August 1979 article. After the publication of the 1983 article, I said to one of my colleagues, "Watch out, the fun is over." And the equity market fun was sidetracked, if only for a while. Business Week said sell when the Dow Jones Industrial Average was at 840, and buy after it had climbed to 1200. Yet 2 years after the buy recommendation, in May 1985, the Dow still languished at about 1200. It may be unfair to single out these Business Week classics. Time gave us an equally poignant example of the hazards of taking strong and unequivocal stands on the future course of the stock market. In its September 26, 1988 issue, Time ran a cover story titled "Buy Stocks? No Way." The cover pictured an enormous bear. The article included these pearls of wisdom about the stock market. "It's a dangerous game. It's a vote of confidence that things are getting worse. The market has become a crapshoot. The small investor has become an endangered species. The stock market is one of the sleaziest enterprises in the world." When those words were published, the Dow Jones Industrial Average was at the 2000 level, down from the peak of 2700 reached just before the market crash of October 1987. Since then, the Dow has topped 9,000, greater than a fourfold increase. Investors who acted on Time's conclusion would have sat mournfully on the sidelines through one of history's most powerful bull markets. I intend neither to slam Business Week and Time nor to offer them as the perfect contrary indicators, those wonderful sources whose advice is so consistently wrong that we can count on profits simply by doing the opposite. My point is, the market is simply unpredictable on any short-term, month-to-month, or even year-to-year basis. We should not expect it to be predictable, nor should we base our investment decisions on impulses inspired by the conventional wisdom of the day. Whether they come in large headlines in respected publications or arise from our own daily hopes and fears, these calls to action generally have a short-term focus that muddles our view of the long term. Unfortunately, the available data suggest that, rather than ignoring the impulses engendered by the press or by emotional responses to market swings, the individual mutual fund shareholder responds to them with alacrity and follows the crowd. Mutual fund investing has proved to be extremely market-sensitive, as fund shareholders overreact to fluctuations in stock prices. The stock market crash of October 1987 caused many otherwise rational investors to abandon the stock market. But as soon as the bull market resumed its rampage, these same investors changed their course again. Cash flows into equity funds resumed in full force and remained positive in each quarter through mid-1998. What began as a tiny trickle became a roaring river. Net purchases of $1 billion in 1983, the first full year of the bull market, multiplied more than 200 times and reached $219 billion in 1997. If massive mutual fund inflows and outflows from investors remain contrary indicators, the industry's recent cash inflows may not be good news. But whatever the future may hold, These figures are one more manifestation of one of the great paradoxes of the stock market. When stock prices are high, investors want to jump on the bandwagon. When stocks are on the bargain counter, it is difficult to give them away. It is not only in their love-hate relationship with equity funds that investors reflect their short-term orientation. They have come to adopt another short-term strategy: rapid turnover of their equity fund holdings. The tendency of investors to follow high turnover policies in their own mutual fund portfolios has reached staggering proportions. No doubt fund investors came by this short-term philosophy honestly. They learned it from the portfolio managers who run the funds they own. From the 1940s to the mid-1960s, annual portfolio turnover of the typical general equity fund averaged a modest 17%. In 1997, average turnover of U.S. equity funds stood at 85%, an amazing five-fold increase. Portfolio managers, on average, were holding the stocks in their portfolios for only slightly longer than 1 year. It was odd behavior for investment advisors, who are entrusted with the fiduciary responsibility to manage clients' assets prudently. Instead, they were shuffling through their portfolios like short-term speculators. During the past few decades, abetted by the proliferation of sophisticated communications technologies, portfolio managers of other people's money have adopted a new method to try to beat the market: rapid-fire trading, a practice that can burden investors with enormous portfolio transaction costs, as well as staggering tax costs. As Columbia Law School professor Louis Lowenstein expressed it in the 1998 article, mutual fund managers exhibit a persistent emphasis on momentary stock prices. The subtleties and nuances of a particular business utterly escape them. Despite the example set by some of what I describe as the best practice mutual funds, those that follow relatively steady, low-turnover policies, the mutual fund industry pursues a far less productive path. Fund managers also ignore the lesson of long-term investing set by Warren Buffett, without doubt America's most successful investment manager. The turnover in his huge portfolio, limited to a relative handful of stocks, is not only low, it is virtually non-existent. One might well ask, why should any fiduciary behave differently from the Buffett principles? Mr. Buffett describes his extraordinarily productive investment approach as keeping most of our major holdings regardless of how they are priced relative to current intrinsic business value. A till-death-do-us-part attitude. We are searching for operations that we believe are virtually certain to possess enormous strengths 10 or 20 years from now. As investors, our reaction to a fermenting industry is much like our attitude toward space exploration. We applaud the endeavor, but prefer to skip the ride. Mr. Buffett doesn't cotton to the high turnover that characterizes mutual funds. Investment managers are even more kinetic. Their behavior makes whirling dervishes appear sedated by comparison. Indeed, the term institutional investor is becoming one of those self-contradictions called an oxymoron, comparable to jumbo shrimp, lady mud wrestler, and inexpensive lawyer. Given this situation as it exists in the modern mutual fund industry, Mr. Buffett quickly comes to the correct conclusion. An investor who does not understand the economics of specific companies but wishes to be a long-term owner of American industry, he says, should periodically invest in an index fund. In this way, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. Money invested for the long term, like the proverbial plodding tortoise, wins the race over speculative money, analogous to the fits and starts of the hare. The mutual fund industry is ignoring this truism. Let's consider whether the fund industry's rapid turnover might possibly be the side effect of well-executed plans for earning superior investment returns. The obvious answer is, for the industry as a whole, it cannot be. Now controlling 1/3 of all stocks, fund managers are largely trading, not with